In a world that is always evolving and ever changing, one thing that none of us have absolutely any control over is how fast time flies. And that's why in this video I'll be sharing with you 10 extremely important financial terms you must know by age 30. So definitely watch till the end to get the full gist. Hi Magis gang, my name is Majojiba, Maji for short. If you're new here, you are welcome to my channel, and if you're a returning subscriber, welcome back. It's always a pleasure to have you here with me again. I hope everyone's having a good week so far and you are not letting anyone or anything dim your light. Your net worth is the amount by which your assets exceed your liabilities. In simple terms, net worth is the difference between what you own and what you owe. If your assets exceed your liabilities, you have a positive net worth. Conversely, if your liabilities are greater than your assets, you have a negative net worth. Regardless of your financial situation, knowing your net worth can help you evaluate your current financial status and plan for the future. Your net worth will fluctuate, however, it is not the day-to-day value but the overall trend that matters. As you age, your net worth ideally should grow. By knowing where you stand financially, you will be more mindful of your spending and be better prepared to make sound financial decisions, as well as be more likely to achieve your short-term and long-term financial goals. Assets are anything of value and personally owned. The more assets that are acquired contributes to the overall creation and preservation of wealth, which ultimately benefits you and your family. Assets include cash, various investments, art collectibles, bank accounts, brokerage accounts, retirement funds, and personal items like your car or jewelry. Real estate can also serve as an asset if there is a zero balance owed to a lender. Liabilities, on the other hand, include your mortgage, loans, credit card debt, student loans, and any other debts that are owed for payment. Interest rate is a computed percentage based on the principal amount borrowed from the lender. Your credit score, terms of the loan, and the loan type are just a few examples of what can increase or decrease an interest rate. When in the market for a car or home, it is best to shop around to make sure you are getting the best interest rate possible. Anything that is protected by collateral can be classified as a secured loan. A car or mortgage loan are common types of secured loans. On the other hand, anything that is not protected by collateral can be classified as an unsecured loan. Unsecured loans include student loans, credit cards, and personal loans. These unsecured loans typically can have higher interest rates. The principal is the original amount of money borrowed. All loans typically include a principal and interest payment, and the interest payment is a percentage of the initial borrowed amount. The term liquidity seeks to answer this question. How quickly can an asset be turned into cash without compromising its value? Cash on hand in a checking, savings account, mutual fund, stock, or treasury are examples of things that can be converted into cash fairly quickly. A credit score is an objective summary of the information contained in your credit report at a particular point in time. The score is a 3-digit number that lenders use to help them make decisions. Lenders use your credit score to determine whether or not to grant credit, and if so, how much credit and at what rate. A higher credit score indicates that the individual is a lower credit risk. While the overall purpose of credit scores is universal, each lender will use his or her own criteria to measure an individual's credit worthiness. Typically, the higher your credit score, the better. Your payment history is typically the most important aspect of your credit score because it shows how you've managed your finances. Your credit report is a snapshot of your financial history. It is one of the primary tools that credit grantors like banks and credit card companies use to decide whether to grant you credit. Your credit report may include the following information: identity information such as your name, current and previous addresses, social insurance number, telephone number, date of birth, and current and previous employers. Your credit history, which refers to the history of payments to credit grantors. Public records, that is, items that may affect creditworthiness such as bankruptcy and judgments. Inquiries, basically referring to a list of credit grantors and other parties authorized by you and or by law that have received your credit information, and other information which include banking information and or collections. Your credit report does not include your income, purchases paid in full with cash or checks, or information about your business and or personal accounts. It also does not include any information about your medical history, ethnicity, political affiliations, or criminal record. Capital is a broad term that can describe anything that gives value or benefits to its owners, such as a factory or its machinery, intellectual property like patents, or the financial assets of a business or an individual. While money itself may be seen as capital, capital is more often associated with cash that is being put to work for productive or investment purposes. In general, capital is a critical component of running a business from day to day and financing its future growth. Common sources of capital include friends and family, personal savings, angel investors, venture capitalists, corporations, private loans, federal, state, or local governments. Okay fam, that's all for today. I hope you found this video helpful. If you did, please remember to give me a thumbs up. If you're not yet subscribed, please also remember to subscribe to my channel and join my Gist gang. I will see you all in my next video, but till then, as always, stay blessed and remember God loves you. Bye.